it now. Good afternoon, and thank you for joining us today for TAD's webinar, A Review of Accounting and Tax for Home Health Agencies. TAD was founded to provide an option for home health agencies to outsource their billing and accounting services to industry experts. Our esteemed billing specialists, accountants, and CPAs have dedicated themselves to the home care industry and bring their knowledge to you today. I'm Mary Reyes, Director of Operations for TAD, and I will be your moderator this afternoon. It's my pleasure to introduce Dan Parker and Alexandria Rochko. Dan is one of the founders of TAD. He has his MBA and has been a CPA for over 35 years. He has practiced in the public accounting throughout his entire career and has serviced the home care industry since 1981. Alexandria Rochko. Alex is over 25 years of accounting services, including 16 years in the home care industry. She has her associate's degree in accounting. Alex worked for several CPA firms for over 11 years prior to coming to TAD. She has hands-on insight of the cost report process and has an in-depth understanding of the accounting requirements for home health agencies. All of our attendees are in listen-only mode, but please feel free to send your questions to us throughout the webinar via the question box on the lower right-hand corner of your screen. If you're listening to our recorded presentation, our contact information is listed at the end of the presentations, and you can email us your questions if you'd like to discuss our services. So without further ado, I'd like to turn the microphone over to Dan.
Good afternoon, everyone. Thanks for joining us. My name is Dan Parker, and I'm here with Alex Rochko. And even though the home care industry is facing some significant changes going into the new year, which is just about 2 weeks from now, we still wanted to deal with accounting and tax issues that are important to home care agencies. You know, most of the emphasis, certainly in the last year, has been on the new payment model, the PDGM payment model. And then more recently was the somewhat surprise reduction in RAP payments and how that would affect an agency's cash flow going into 2020. And then we have Illinois and Ohio currently on the RCD Review Claim Demonstration Project, which we will soon have the state of Texas, Florida, and North Carolina. So having said that, let's talk a little bit about organization formation. Although likely all of you are certified, been in business for a number of years, we really operate home care agencies under 3 different organizational frameworks. One being the corporation, where most home care agencies utilize this type of entity. We have limited liability companies and sole proprietorships. Each of these 3 entities have their own attributes, especially not necessarily coinciding with each other. And this is something I just want to touch on as we go through the slides. So let's start with a corporation. Easy enough, corporations operate by utilizing a set of bylaws. And the bylaws really are the operating procedures on how the corporation functions. I won't spend much time on bylaws. Keep in mind too that corporations, we have for tax purposes, C corporations under the IRS code, as well as S corporations. By far, S corporations are the most prevalent type of entity for small businesses in this country. My last reading of the IRS statistics had S corporations about 95% of all corporations. So by far, it is the most used type of electing entity that there is. We also have within a corporation, a C or S, And we'll talk more about S's on the next slide. Let's get back to the corporation and stock certificates. Again, this may be something that gets overlooked, has been overlooked by smaller agencies, and that's really who our target market is today, is smaller agencies where certain things generally are left to their corporate attorneys and don't really have much emphasis placed on either the bylaws or stock certificates.
Dan, I have a story about an agency that did not have stock certificates. There were 6 nurses who started an agency. The nurse responsible for putting the ideals in the group together became the administrator and marketer. She did a phenomenal job, and in the first year, the agency had did over $1 million in revenue. Second year was expected to exceed $2 million. They got out of the startup debt and decided to start distributing profits to the 6 owners. Immediately, a disagreement of the percentage of ownership came up. The main nurse believed she owned 50% and the other 5 owned 10% each. The other 5 nurses believed that they were all equal at 1/6 or 16th and 2/3% each. After a long, expensive legal battle, the court ruled 1/6 each due to lack of stock of certificates. The main nurse resigned and the agency closed. And it's sad, but you definitely make sure you have your stock certificates with corporations.
Now, most of the time where we'll run into this issue is upon an IRS audit of the agency. Certainly on their list of information requirements will be stock certificates, will be corporate bylaws, and corporate board minutes of meetings that are supposed to be held minimally once a year. And again, we've seen enough times where audits are conducted and the agencies go back and recreate years and years and years of annual board meetings. And it just gets a little bit difficult to do, as not only time passes between those board meetings, but also changes of shareholders have occurred or partners have come and gone, and it just makes it more difficult. So what we want to get to now is the S election. The S election is something where a corporation has the ability and option to elect to be taxed differently than a C corporation. As I mentioned before, 95% of all corporations in this country have elected to be taxed as an S corporation. And there's a couple of things that I'd like to discuss. You may ask, why in the world would we have such a preponderance of S corporations? And it's primarily due to the fact that you eliminate the C corporation taxes. Taxes of a C corporation under the new Trump tax law a year ago lowered the tax rates from the high of 35% and lowered it down to 21%. Now, at the same time, we'll get to this a little bit later, flow-through entities such as an S corporation and a limited liability company, and yes, a sole proprietorship, can avail themselves to something called QBI deduction, qualified business income deduction, which is really a 20% deduction off of the flow-through income coming off of your S corporation or your LLC or your sole proprietorship, but we'll get to that. Couple of things that people don't realize. If you currently are a C corporation and you're entertaining some discussion relative to effective this coming year to change over and to elect S, all it would take is simply, as you see on the screen, filling out form 2553, a very simple form, and it's something that you could do hopefully with advice from your CPA. And what I mean by that is that it's not all as cut and dried as you may think. Even though the form is simple, there is an issue that catches some home care owners by surprise, and let me explain. Let's say you've operated for a number of years as a C corporation, and you look at it and say that, well, I'd rather be an S corporation. I could take advantage of this new QBI deduction. All of my K1 income is not subject to self-employment tax, that type of thing. I can save on payroll taxes. However, if you have been in business for any length of time, what likely will have happened, of course, is you'll have accumulated, if nothing else, an accounts receivable. Now, the accounts receivable falls under something called a built-in gains tax. Built-in gains is a tax that applies if a S corporation disposes of appreciated assets within 5 years after electing S status. Now, okay, so in plain English, what does that mean for my service business, my certified home health care agency? Let me give you an example. So let's assume that you are been in the business for a while, you're a small agency, and let's use the example that at the end of December 31 of 2019, you had accounts receivable of $100,000. So, and I'm also presuming that you use, and I hope all of you do if you're a S corporation or C corporation, the cash method of accounting, where you don't recognize income until it's collected. You don't recognize expenses until they've been paid. So it's a great tax deferral method if you're in a service business to operate under the cash method of accounting. So here's my example. A corporation using a cash method accounting elects to become an S corporation effective January 1, 2020, when it has accounts receivable of $100,000 for services rendered before that date, meaning say in 2019. And of course, the fair market value of those receivables hopefully is $100,000, meaning say that they're all legitimate and collectible. Now, the tax implication is that the adjusted basis of these receivables is zero because you do not have paid income tax on that uncollected money. So during 2020, the company, of course, collects all of the receivables that existed in 2019. Let's say it's the $100,000 and includes that amount in gross income. Cash collections, part of gross income. The company now has to recognize the entire $100,000 as a built-in gain. And this built-in gain, this $100,000 in my example, is subject to a income tax, a C corporation income tax at the rate of 21%. So $21,000 that the corporation, now we're talking about the S corporation, would have to pay upon filing their 2020 end of the year tax return. So this is something that I've seen enough accountants sort of bypass this particular tax area and not really fully explain this to their clients, the risk you may take by converting from a C to an S. But I just wanted to bring up that point of this built-in gains tax. All right, so moving on. So what happens normally, and let's presume you've gotten past this built-in gains issue, we now have your acceptance as an S corporation.
Dan, another thing with the 2553 form, it can also be used for an LLC to elect to be taxed as an S corp as well.
That is true. Even though an LLC with more than one member is considered a partnership, it can too also elect to be taxed as an S corporation by simply filing the 2553 form. Now, what's important in this issue, as you see on the screen, we have two very important paragraphs. Paragraph number 2, and this is extremely sensitive due to the fact of this new qualified business income deduction we'll speak about. When a shareholder employee of an S corporation provides services, meaning to say the stockholders, to the S corporation, a reasonable compensation needs to be paid. And of course, this is like, we're talking about W-2 income here. and you must owe the FICA tax, the Medicare tax, the state unemployment tax, the federal unemployment tax on this type of wages. Now, also, in the next paragraph, it says that reasonable, keep in mind that shareholders need to be aware that under this particular revenue ruling, that if you don't pay a reasonable compensation, but rather take it out as S corporation dividends, the IRS could certainly recharacterize those dividends as reasonable compensation. And why do people do this? Well, it's easy enough to explain. They'd rather reduce their compensation and take out the money by way of a dividend. The dividend or distributions in an S corporation are not subject to the FICA tax, the FUTA tax, the SUTA taxes. And so that's a pretty convenient way of bypassing the payroll tax liabilities. And so once again, the IRS has emphasized that reasonable compensation must be paid. We have come across audits over the years of S corporations, and there's no question that top of the list of any particular S corporation audit, you'll have the auditor looking exactly at the W-2 wages paid to the shareholders or officers, employees of the S corporation. Anyone that would be receiving a K-1 from that S corporation.
Dan, I think it's also important to note that an S corporation shareholder must be a citizen or a resident of the United States. Therefore, you cannot be a non-resident alien and own shares of stock in an S corp.
Yeah, this is something that sometimes is overlooked by owners of perhaps a C corporation or someone who's just now organizing themselves and electing S corporation status. You have to be a U.S. citizen. Moving on, let's talk a little bit about LLCs. As Alex mentioned, an LLC can be taxed and elected to be taxed as an S corporation, or it can remain an LLC and be taxed more like a partnership, where again, the income is flowed through to the personal income tax returns. The LLC does not pay any sort of LLC income tax, as does an S corporation really doesn't pay any corporate income tax. It all flows through to the shareholders or to the members of the LLC, and that's where they pick it up as income and pay tax on their personal 1040 tax returns. Now, why we see LLCs in the home care area, we see it just because of the fact of multiple partners. We don't particularly like to be a S corporation if there's more than 2 or 3 shareholders. We've seen agencies that have 5 or 6 partners. We would highly recommend that you operate as a LLC, where you go, instead of having bylaws, you have such a thing as an operating agreement. The operating agreement is a very flexible document. It can be adjusted year in, year out to accommodate people leaving, people coming, duties and operations, profit splitting, loss splitting. It's very easy to be so much more flexible when you're an LLC. And we don't call them partner interests, we call them membership interests. Now keep in mind, the difference in an LLC is that you, and we'll get to this on the next two slides from now, we'll talk more about guaranteed payments that must be paid to members of the LLC versus W-2 wages. We'll get to that though. The last of the 3 types of operating entities is the sole proprietorship. Rarely do we ever come across it. I bet over the years we might have had 3 or 4 agencies who were relatively new, then decided at one point in time to operate as a sole proprietorship, one owner obviously, and over the years we've seen them convert themselves to a corporation. You can actually do a tax-free transfer of assets out of a sole proprietorship into a corporation without having to pay any tax. It's just a tax-free exchange of the assets of the sole proprietorship in exchange for the corporate stock of the newly formed corporation. So one does have the ability from a tax standpoint to convert from a sole proprietorship to a corporation.
Dan, I have another story of a past client we had. Being a sole proprietorship, she had cancer, and she was the owner, and then there was her husband was helping her run the agency, and her son. And unfortunately, she passed away. And by being a sole proprietorship and them not changing over to an S corp or anything, everything froze, and it was a nightmare. I think up to about a year, wasn't it, Dan?
Yes, that's correct.
About a year, and they finally were able to get everything switched over, and that was, and her husband and son were, yeah, in awe because they didn't know what to do. It was sad with
So
the sole proprietorship.
again, we don't really ever recommend that you operate this way. Again, the last point on the slide being absolutely no liability protection. So any sort of court judgment against the entity of the sole proprietorship, it's not an entity under the business itself, could put at risk the owner's own personal assets. So if nothing else, it's the fact that there's no liability protection, and that's enough of a motivation to not elect this type of business structure. So I wanted to talk about the differences between the three types of operating entities for tax purposes. We have the C Corp, not used nearly as much as it once was, as we talked about earlier. We have the S Corp and the LLC. These two make up 99.9% of all clients we have here at TAD. And once again, we could just go through the line items. Profits are taxable personally. So again, you would receive in an S corporation form of owner compensation, W-2 wages, subject to the payroll taxes, subject to income tax. And in addition to that, you would receive a Form K-1 each year, which would have the profits that need to be reported and taxed on your personal return, assuming profits. We all hope it's profits.
Yeah.
On the LLC side, once again, the K-1 is a form very identical to an S corporation K-1, where again, your profits are reported and you pay tax on it. But there's a big difference here. In an S corporation, self-employment tax is not part of the tax on your K-1 income. Means say there is no self-employment tax on the owner's share of the profits. And in a limited liability company, as a member, we're not called partners, we're called members, you do have to report and pay self-employment tax on your profits that are reported on that Form K-1. Also, in an LLC, as you can see under form of owner compensation, a member is not ever considered an employee of an LLC. They are members, and how they are paid is what the tax rules call a guaranteed payment. And pretty much what it is, it's a draw, if the best way to describe it. And what it requires then is that the members pay quarterly estimates. And these quarterly estimates due on April 15th, June 15th, September 15th, and January 15th would include the estimated amount of income tax on your guaranteed payments, as well as the estimated amount of self-employment tax. Self-employment tax at this level is, when you're including both FICA and Medicare, is 15.3%. So it's a hefty amount of tax to pay on these guaranteed payments. Oftentimes we've seen in the past where other accountants have considered payments to the members in an LLC as W-2 wages. That's absolutely wrong. Keep in mind, the member is not an employee. Obviously, your other people that work at the LLC are W-2 type employees. So there we have that. Excessive compensation is not a problem in an S Corp and an LLC, and really it's not, we just don't have enough C Corps that operate this way to even make mention, pay much time to that particular issue. Losses, if you do have them on both S Corp and LLC, do flow through to the individual and are deductible if, in fact, you have tax basis. And we'll just leave it at that.
And Dan, a note, it's very important to discuss these topics with a professional before making a decision on a form of an entity or electing a change if already organized. With a home health agency, like Dan mentioned before, the 2553, you have to make that with the IRS, but you do also, it's very important, and we've had clients not do this, but an 855A, you have to make a change there too, for the home health agency, to remember.
Now, under organizational issues, let's touch on this to some degree. What we would always love to see as the outside CPA accountants would be, in the event a member leaves or a shareholder leaves, that there be in place some sort of written agreement, not verbal, written agreement, on how to determine a price to pay for a departing shareholder or a departing member. I would say in my years of dealing with agencies, 9 times out of 10, no such agreement exists. And it's also been my experience to tell you, without an agreement, we have seen these members or shareholders end up each dealing with appraisers, each dealing with lawyers, and a fierce argument always arises as to what the value of the departing person's shares or membership interests are. There'll never be an agreement between the ones staying versus the ones going. So that's why buy-sell agreement is something that's a very easily put together document. It can be a one-page document. And basically what it tells is, what it spells out is how the value of a entity, whether it be a corporation or an LLC, be set at the time of someone departing. And again, terms of the sale, whether it be an installment price that will be paid over time, or whether it just be one lump sum payment. Most of the time it is a payment spread out over a period of months and sometimes years.
Dan, we got a question. An agency has been in business for 4 years. Is it too late to prepare a buy-sell agreement?
Never is too late to prepare an agreement like this. And if you've been fortunate enough that you haven't had this issue where someone has left without some sort of argument arising, you've been very lucky. It's only a matter of time as far as I'm concerned. Also, an agreement that we need to look at annually is compensation setting and job duties spelled out and responsibilities of the owners. Oftentimes we may have equal partners who do very different services, render very different services to the home care agency. And one may say that those partners don't necessarily have to be paid equally. And I think we've run across this more times than not, where you do have problems when you're paying all of your shareholders or members identical wages, where it's almost impossible to have duties and responsibilities that are identical and valued at the same amount. But it's good to talk about it. We're near the end of the year again. Take a look at where the agency stands and going forward as to how best to set compensation. So again, all of this leads to the fact of having fewer disagreements between the owners. So as we can see, the importance of good planning here, now that we have all flow through entities, being S corporations or LLC, good tax planning occurs throughout the year. We've seen too many times where you really don't have a handle on where you are at from a tax standpoint until maybe January, maybe February. You maybe should have paid estimated payments. You did not. You're subject to penalties. And who likes a big bill come April 15th when you have to file your personal return? Nobody likes that. So without a doubt, in today's world with these flow-through entities, your business and personal taxes are absolutely related. Now, what I would like to get to is relative to what came about under the new tax law a year ago was what we call QBI, Qualified Business Income. This allows an entity shareholders and members to deduct 20% of the profits that are generated and reported to you on Form K-1 each year. It's a terrific deduction, and the reason this was put into play for the flow-through entities, the S's and the LLCs, was since they dropped the C corporation tax rates from 35% to 21%, this particular item, the QBI, was put in to sort of level the playing field between the C corporation and the flow-through entities. But basically, in its simplest form, a member or a shareholder is allowed a 20% deduction off of the reported profits. Now, that's all fine and well. However, we find in the home health care industry that we qualify under what we call the specified service trade or business. Basically, particular services were put into the tax law that there's a phase out of this 20% deduction if you are one of these specified service businesses. In a home health care, anyone in healthcare type of business is a specified service trade or business, an SSTB. So what that means, in more simple forms, is that whatever the K-1 amount might be, you would look at whether or not I can get my 20% deduction on my personal tax return. It works fine if your taxable income is less than a certain dollar amount, meaning to say, if you file a married filing joint return for the year 2019, and most probably do, this 20% deduction starts to phase out after you have taxable income that exceeds $321,000. So you might say, well, I'm not even close to $321,000. Then you're fine. You will get the 20% deduction. For those taxpayers whose income goes from $321,000 to $421,000, filing a joint return, you phase out of that 20% deduction. So if you're at $421,000 and higher, you get 0% deduction. Now that's filing as a joint return. If you're a single filer, the rates are about half, meaning to say if your taxable income is $160,000, between $160,000 and $210,000, you will be phased out. So again, this is taxable, this is not adjusted gross income, this is taxable income after deductions, after adjustments to gross income. If your taxable income is less than $160,000, you get the full 20% deduction. So once again, just to take away from this is that they have now, for 2019, issued separate forms. This was a little more difficult last year. The first year it was in the tax law 2018, 2019. The IRS has issued a slew of forms that takes you through the calculation and the formula as to whether or not you will either get the full 20% deduction or be phased out to something less than 20%. And I think we talked about the distributions versus W-2 versus guaranteed payments in a previous slide. Once again, though, we find that the S corporation, I believe, probably throws off more tax benefits than does the LLC under the new tax law. So back to the entity itself, we have two methods of accounting that the IRS allows us to work with. One is the cash basis, as we talked about before. Anyone in a service business should file its tax returns on a cash basis. And of course, why we use the accrual basis, the Medicare cost report requires that you file on the accrual basis. And basically what that means, it reflects your current accounts receivable, your current accounts payable, and your current accrued expenses and deferred income. All of these items get into play under the accrual basis of accounting. By the way, this is kind of a lead into Alex here. There has been a change or a proposal to modify the Medicare cost report that you've become so familiar with. There was a proposed rule issued April 16th of this year, 2019. There was a 60-day comment period that ended June 17th. And furthermore, they extended that another 30 days till July. The idea was to finalize the new Medicare cost report for home care and use it for the 2019 calendar year. And I believe that's not going to happen whatsoever. I believe it will be 2020 year that we'll see the new cost report modified and finalized. And I also think that you'll see a significantly more detailed reporting than we've had in the past of both costs, and Alex will get into that, and statistics. Again, this sort of just dovetails into the new PDGM payment model, where they want certain information that had not yet ever been generated on previous cost reports. So I just wanted to throw that in there. And once again, you must file your cost report under the accrual method of accounting.
Before that, Dan, going back to the cash basis tax returns, we have seen so many new clients with accrual basis tax returns paying taxes on accounts receivable, money they have not even earned yet. And you need to look at your tax return page 2 or 3 to see if the cash basis box is checked. If it is not, make a phone call to Tad.
And we could certainly help you make the conversion from filing from the accrual basis to the cash basis for tax purposes. I'm going to slide over here and let Alex take over, and she will have a number of subject areas that you will find quite interesting.
Thank you, Dan. With the home health agencies in certain states, as in Illinois and Michigan, it's the law that you have to have workers' comp insurance. Now, with workers' comp, even if you have one employee, you still have to have workers' comp insurance. With that will take the workers' comp insurance will take care of your employees. And what I mean by that is if they're driving to a home to see a patient and they get into a car accident, they will be covered under your workers' comp. So if they're on the clock for you, for your agency, then that falls under workers' compensation. The highest rate, there's two class codes. It's 8835, which is, we call it the visiting staff with workers' comp, and then there's 8810. And 8810 is the employees that work in the office. They're usually the billers, the intake, office manager, and that's a much lower rate because there's not a high risk of them getting hurt compared to an employee that's going to see a patient. Now, this always becomes an issue when you have a yearly audit, is called the subcontractors. They need to have their own workers' comp. Now, just for an example, I just did an audit last week, and one of our clients did not get the certificate of insurance, it's called, for the subcontractor, and he paid him over $200,000 in that fiscal year of when the policy is. Guess whose policy that falls under? If you do not have certificate of insurance, unfortunately, the auditor will have it fall on your agency's policy. And so it's very important when you hire a subcontractor for a PT, OT, ST, you need to ask them, the first thing is, I need your workers' comp insurance. It's called certificate of insurance, because there are insurance companies out there that will not accept the first page of the declaration of their policy. It needs to be the certificate of insurance. So please, because I've seen it years and years where they do not have the certificate of insurance, and the agency needs to be charged for what they paid that subcontractor. Now, the professional liability is very important, and there's a thin line between a professional liability and a general liability. The professional liability will, insurance will be covering your agency if, say, for example, one of your employees or yourself went to see a patient and the patient had fallen, and the family comes back to sue you, then that's where your professional liability insurance comes into play. Now, a general liability, some agencies gets both the professional and general, which it's a good idea to definitely have both. But the general liability is if, say, going back to that patient, but you broke something in their house, or you caught something on fire in their house or something, and that's where your general liability comes into play, is if they come back at your agency because your employee did this. So well, you definitely have to have your professional liability. That is under the Medicare ruling. That's one of the audits when a surveyor comes out. They ask to see your professional liability certificate of insurance. So that you definitely have to have. The general liability, that's up to you. A lot of times the insurance agent will recommend that you get both, because there is a fine line there between professional and general liability. But in the state of Illinois and the state of Michigan, it is the law to have also workers' comp. So if you have one employee or more, you definitely have to have your workers' compensation. Now, for the income statement, a monthly comparison allows you to stop bad cost trends quickly and not drag them out past year end and maybe even further, because they're buried in a full year statement and you don't notice it timely. Also, if revenue is taking a hit because of regulations or referral decreases, then expenses need to go down if you want your agency to survive. One of the departments, unfortunately, when we look at an agency and the referrals went down extremely and they're crying to us, and that we unfortunately have to tell them the overhead of wages of the office, because the employees, either we tell them to cut hours if they can cut hours of the employees in the office, or or have to let someone go, unfortunately. But usually that's where one of the biggest hits have to take place, when an agency's referrals goes down. And you never want to touch the direct cost, which is your visiting staff, again, skilled nurse, PTs, OTs, STs. They're the driving force that brings in the revenue.
I just wanted to also make mention that having a monthly type of income statement that TAD prepares for all of its clients is especially crucial going into the new year under the new payment system. The average home care agency's revenues in this country, and again, it's an industry dominated by very small providers. 80% of the 10,000 home care agencies are considered small providers. The average revenue is about $1.5 million. Now, with the change in wrap payments, where the 60 to 50 and 50% payments were made upon dropping a wrap down to 20% now, it is expected that agencies' cash collection cycle, the time it takes to collect your cash, will lengthen out from anywhere from 3.5 to 4 weeks. Now, that, and basically in dollars and cents, it's probably going to result in somewhere close to $100,000 cash flow shortage for the average small provider. So again, it's critical that you know where you stand each month on a profit and loss standpoint. Like Alex had mentioned, if in fact we're looking at revenues or referrals declining, you've got to be able to be profitable to generate positive cash flow, unless you have a very, very friendly lender, whether it be your bank, your rich uncle, or yourself, in order to get you past this hump, because obviously there's going to be a period of time where cash is going to be certainly short as this new payment system and the wraps and the decrease in wrap payments take effect. We're looking at probably late January, probably more February, March, April will be extremely difficult cash flow months coming into the new payment system.
Yes, and another thing, Dan, here at TAD, on a quarterly basis in the accounting department, we look at your income statements and we do tax planning too, to either do bonuses for the owners or
Make estimated
or
tax.
make it, yes, or change the estimated taxes that you'll have to give too. Okay, as Dan mentioned a couple times, the PDGM that is coming in effect in January. It is very important now, well, it always was, but now you have to break out your payroll in departments. As you see here on the screen, you need to, any of your administrators need to be in that proper department, administrative, supervisors, skilled nurse, and what's new is you also have to break out the LPN. This is all due to the cost report.
Yeah, let me just butt in there if
Yeah.
you don't mind. We're certainly anticipating that we will see separate reporting categories for LPN payroll
Yes.
and your PTA and OTA type of payroll costs coming in with the new cost report, which we think will be 2020.
Yes. So you need to make sure your agency already has these departments broken out in your payroll. And like in note 1, if visits are performed by anyone in the first 3 departments, the payroll associated with these visits should be recorded in the department for the appropriate discipline. Now, note that independent subcontractors that I've mentioned earlier require discipline departments as well. Now, an employee versus the independent contractor, or we call them subcontractors or 1099s. When a W-2 versus a 1099 or subcontractor, a W-2 is an individual that you have management control over. So for an example, if an employee comes in and, I mean, if they are an employee and they come in and they work from 9 to 5, they need to be under or be as a W-2, which they will receive a W-4, they'll fill out the form, and you will put them on payroll as a W-2, which taxes will be taken out. Now, a subcontractor or 1099 individual, they can come and go as, I mean, you give them your, where they have to go, their assignment and that, but you do not have control. They work for another company, or you may never see that particular individual because, as I said, they work for another company that you hired. and they are subcontractors. They
Yeah,
will get a 1099.
let me just elaborate. Where we find this to be a real issue, and it has been habitually a issue with home care agencies for 30 years, is the fact that field people, primarily nurses and home health aides, would be put as a contractor on a 1099 form. The reason being is that the owners feel they can save on the payroll taxes. That is absolutely wrong. You will lose in an IRS audit 100% of the time, simply because you have control over the nurse who has control over the home health aide. There's no getting around the fact that this is what happens in reality. And so therefore, the only 1099s that qualified type of individuals we see in a home care agencies are therapists, where once again, you don't have control over them. And in fact, these laws, again, it's been an argument forever with the IRS, who qualifies, who doesn't qualify. States themselves are beginning to change the laws relative to this. And I can mention one state, the state of California, has now come up with, in the year 2022, where they have said if the independent contractor provides services that are similar to the entity's services, they are a W-2 employee. And once again, California seems to lead the country in legislation relative to this. You've seen this whole, just mention Uber and the controversy they are having there, where these drivers feel they should be employees and not contractors. That whole theme is just being expanded into all kinds of other industries, including the home health care market. So the last audit you'll ever want to see is a payroll employment tax audit when the IRS comes knocking, where they'll take a look at your people, and they're going to look at those 1099 people as to whether or not they should have been recharacterized as employees. If they are recharacterized, not only do you owe all the payroll taxes, the FICA tax, the Medicare tax, the FUTA tax, they will go back not only in the current year that they've started the audit, but at least 1 year back, and assess you not only the tax, plus penalties and interest. It can be a devastating blow for a home care agency to have this type of audit.
And an example of a couple of clients in the past, it actually starts state level. What happens is the unemployment state auditor gives you a notice that you're going to be audited, and what they're looking for, are you true, as Dan said, are you truly a 1099 or are you a W-2? So they come in first, and then they look at all the invoices that you receive from the subcontractor, and you need to have those invoices, and they will see, and if they, as Dan said, do not believe that they're a subcontractor and should be a W-2, you will be taxed the unemployment tax rate. Then they forward that to the IRS, which Dan has mentioned. So if you do get a state unemployment audit, it usually means they're opening the books to see, are those truly subcontractors, or should these individuals be W-2? And one of their big questions is, we want to see, and they usually go a year back. But if they don't think certain individuals should have been a subcontractor, then they can go back to, I think, 2 to 7 years. Is it the
3 to 5 years?
3 to 5 years on the subcontractors, and they want to see every single invoice that you received, that you paid them, and are they truly a subcontractor or not. Another point is the marketers. Now, we here at TAD highly recommend, especially if they're full-time, that they're W-2 employees. And they will have a safe harbor protection per Stark regulations. So with the marketers, if they tell you they want to be a subcontractor and you only see them once, you have no control. But if you have management control, you definitely should put them on your W-2, you should put them on your payroll.
Another characteristic of an independent contractor is they ought to be working for multiple home care agencies, not just yours. You would stand very little chance if the IRS had looked at your records and found out that this particular individual only worked for your home care agency. They must have a legitimate business, and that would be a legitimate set of clients, that being home care agencies. They must invoice you. You just simply cannot calculate in your Paychex payroll system or ADP a number of visits times a rate. They must invoice you. You must have all of these documents at hand at all times.
Yes. And a lot of times they will ask for their tax ID. It should be on the invoice. So they know that they are, like Dan said, a legit business.
Do we have any questions, Mary?
Not at this point. We don't have any questions, but I just have one more point about the marketers. The reason that they should be W-2 employees is because Medicare expects you to have management control over those marketers. There's no cost sharing, just to prevent the appearance of kickbacks or other types of purchasing of referrals. So putting them on W-2 is a key point, regardless of how they operate their business. It's for you just a safe regard. So I mean, you want to advance those to our contact people? Okay. Right now is on the screen is all of our contact information. If you have any additional questions that you think about after the presentation, you can email us. We will be responding to those emails. We'll also be, you can call us and we can talk to you at that time as well. So as you heard today, there's a lot to know about tax and accounting for home care agencies. And if you're not already one of our valued clients, we would love to assist you and your agency with your billing and accounting needs. The professionals at TAD have been providing accounting and billing services to the home care industry for over 18 years and doing tax work for over 35. So often agencies are owned and operated by clinical professionals who struggle to keep up with the constantly changing Medicare and IRS regulations. At TAD, all we do is home health accounting, billing, and tax work. So that our clients are free to focus on the clinical and daily operations of their business. I also just want to update you. Currently, we're running enhancements to our website, but we will be having our webinars available in a pre-recorded situation where you can re-listen to these at your leisure. And you can visit that on the youtube.com channel, searching the accounting department, or you could visit our website. If our website's currently down, it's because we are making enhancements, so check it back again often. And our website is at www.tad-usa.com. So thank you for attending today, and we hope you consider using TAD for your accounting and billing services.